Hi, I'm Battu from FreeFinCal. In this video, let's talk about Nifty Bees ETF versus UTI Nifty Index Fund. A reader asked which is better, so let's try to do a comparison. It's a question that's on many people's mind. Actually, many people believe that just because an ETF has got a much lower expense ratio than the index fund, it will automatically be a better choice. But that need not be the case. Well, it's well known that the Nifty Bees ETF is one of the best ETFs in the country, and the UTI Nifty Index Fund is one of the best index funds. So, if we pit them together, what happens? Now, we have to be a little careful here. It's very easy to make the mistake of using ETF NAV for calculating returns as well as tracking error. This is incorrect because most investors, unless they are capable of buying a huge tranche of units and they can buy and sell directly with the AMC, they'll have to buy and sell with the other unit holders in the investment pool. So for them, the NAV of the ETF is not of much relevance. That's not going to determine the tracking error. That's not going to determine their returns. Only the price of the ETF determines their return, and therefore the tracking error should be measured with respect to price. This is not done, and I think that's a poor practice. That's why we started publishing a monthly ETF screener based on ETF price. So now let's take a look at the 1 year rolling returns of Nifty Bees ETF price, which is a red line, versus the UTI index fund, which is the black line. So you can see that they're barely can be distinguished. They're basically on top of each other. Over 3 years, again, there's not much to say. There's the red line, which is the ETF, just a touch above, and over 5 years, you can see that the ETF is a little bit above. The average, excess return that the ETF has given is like 0.24%. That's basically nothing. And also, there's not much of a history. If you look at the history, this is only 1 year. In the window over which we are seeing the 5 year returns is only about a year, so there's really not much of history, and this excess 0.24% will also vanish if you take into account demat account charges, the brokerage charges, etc. It'll, even if it doesn't vanish, it will reduce even further down. So we have to be a little careful in assuming that just because something is less expensive, it will be better. I mean, as long as the fund is managed well, it can beat even another index fund with a much higher expense ratio. Also, if you look at the historical expense ratios of both these funds, look at the ETF expense ratio. Obviously, the ETF expense ratio is very low. It was much higher in the past, and I think this dramatic drop, I think that coincided with the EPFO wanting to invest in ETFs. Although the Nippon ETF was not chosen, the SBI ETF was chosen. I think so. I think because of that, there was a competition, and that led to the lower expense ratio. That's my guess. I could be wrong. I have not been able to find a proper reason for why the expense ratio was so high in the past and it dropped down. But when it comes to UTI Nifty Index Fund, they kept their expense ratio at 0.1% for a long time. But then once they became popular and once they garnered enough AUM, they doubled it. And so that's just AMC greed, and that's going to always be the case. That's not something that we cannot control. So although there's a huge gap between the expense ratios, you can see that both the funds are basically performing more or less the same. Of course, you got to be careful to use the ETF price and not the ETF NAV. So you could use either one of them, but for most retail investors, I would recommend the index fund, because you don't have the problem of maintaining a demat account. You don't have to worry about price NAV deviations, because however well managed the ETF is, when there is severe market volatility, there will be price NAV fluctuations. Of course, a well managed ETF will quickly reduce those fluctuations as quickly as possible, but for most retail investors, that fluctuation is something that they may not be able to handle, and they may not know how to sell. You may want to place limit orders and so on. Yes, you can always advise them how to sell an ETF, not buy and sell on market price. Use limit orders and so on. But that's not the point. The index fund is the simpler choice, and it's really not much of a difference in returns. So you might as well use the index fund, and UTI Nifty index fund is one of the best out there.